Thank you sincerely for asking me to come and talk to you this morning. A couple of things I did want to talk about. Just to touch first of all on some links. There are quite strong links between Marks and Spencer and Ort. Lloyd just mentioned that Ort was founded in St Petersburg in 1880, and Marks and Spencer was founded in the Leeds market in 1884 by Michael Marks. More recent associations, one of our directors sadly now dead, David Osaka, was a director of Marks and Spencer and chairman of Ort at one time. So David Seekers here this morning is president of UK Ort, and we together share the same values in terms of education and training, and as you described it, Lloyd, giving people a leg up and trying to do our bit in society to help people. Indeed, Marks and Spencer is involved in a program called Marks and Start, which is the largest company-led work experience program in the UK, and been running for some 2 or 3 years now. So we share the same values. Perhaps I should just touch on something undergrads before we get down to the serious things. It is quite surprising actually that Jeremy Paxton said what he said, but I was delighted last week or the week before, and you may have seen the advert we took out subsequently, that which had actually vindicated us. Every men's underbrand and every brand was tested by them, and I'm glad to say we came out top. So I was able to say to Jeremy that things happen to men just as indeed as they happen, I think, to ladies after surgery at the time. It's called gravity. On that note, I think we won't mention undergrounds again. I'd like to talk about 3 things briefly this morning. I'd like to talk about the economy, and what I would know about that, I don't know. I'd like to talk a little bit about M&S, I might know a bit more about that, and perhaps we should touch before I go on recent events, of which I have been very silent. I am normally by disposition a glass half full man, although I have to say in the last 3, 4, 5 months I have felt a little glass half empty in terms of where the UK economy is going. I am worried about how long this might go on for. I do concern myself as somebody who's running a customer-focused business about what effect this will have on the consumer. If you go and ask Marks and Spencer and Tesco's and perhaps a utility like Transco to tell you what's happening in the customer base, we've got some 16 million customers a week, Tesco's has some 25, 30 million customers a week, and a utility would have a similar sort of amount. They will tell you that customers out there are concerned. They will tell you that customers are not feeling that inflation is around 2.2 or 2.3 or whatever the official statistic is %. They will tell you that customers are feeling that inflation is a great deal higher than that. And indeed, if you are on the national wage, which is something like £35,000 a year, you'll find at the moment the bills coming into you are really making quite a big impact on your monthly disposable income. We're seeing that in our business. We saw it in the end of October, early November. We've seen it again since the end of January. We don't know where it is going, and one of the things we're trying to establish, as indeed all other people are trying to do, is what is the run rate? Have we bottomed out? And if we plateau out, of course, it makes life easier because you can plan yourself. Retailers traditionally win without business. Of course, Easter this year, I think, was the earliest Easter for 93 years. This time last year, if you've forgotten, it was Easter, this weekend last year, and it was 28 degrees outside for the next 4 weeks. So that makes life even more difficult to understand where we're headed. But I am, as I say, a little bit cautious about the outlook. I don't think this is a 2, 3, 4 month blip. We are planning in our business for a sustained period of more difficult trading. I think it will run right through the calendar year 2009, which means it will impose on the fiscal year fiscal year 2008, 9, and 9, 10. And we can only do what we can do. But I'll come back to Marks and Spencer's response to that in a moment. The biggest single thing that I think people need to worry about, of course, is confidence. And that's the bit that always worries us, because we wake up every day and we see the newspapers and we're trying to talk ourselves into a more difficult situation. And I'm going off after this morning to stores, and I'm sure when I get to stores, I'm going to Scotland, I'm going to Yorkshire, that people will talk to me about the importance of having confidence, and that's what we hear from our staff. We just want to make sure people feel there is some confidence around, and that people can have some feeling that there's nothing nasty around the corner. When we go back to Marks and Spencer in 1999-2000, we've had a business that was doing pretty well. M&S had a pretty unsurpassed record in terms of profitability and in terms of improving its business for certainly the preceding 20 or 30 years. And we hit a brick wall. And why did we hit that brick wall? Well, we hit that brick wall because we had, frankly, what might be described as a bungled succession. And at the same time as we had the bungled succession, we were just actually entering into that period, which is the great deflationary period that we are now coming to the end of. And what happened is, when people were focused internally on what was happening in the business, they forgot to look outside and found that when they did look outside, the world had changed. We were going into this period of massive deflation, and at the same time, Marks and Spencer felt that it could actually trade on its historic trading stance, which was on quality or value, and that people would understand what M&S value stood for, and indeed they did for a period of time. But what happened after a certain period of time is that when pricing came down externally, we were not immune to the value crunch that came. People suddenly looked around at M&S and said, you are no longer the good value you are, and that's where we got into trouble. And had we been focused externally and not internally, we would have easily dealt with that situation within a year or 6 months, and we didn't. And what we forgot was, we forgot the core values which we trade under. We forgot the words quality, we forgot the words value, we forgot the words innovation, and we forgot the words trust, and we forgot the word service. And when you do forget those things and forget what you stand for, and M&S only stands for 3 things. It stands for product, it stands for product in decent shops, and it stands for serving customers well. So it's about product, it's about environment, and it's about service. And you soon very much pay the price for what you do. We went outside for management, we suffered as a result, we lost our confidence, and we lost 6 years in our business. And I think it's probably the most expensive 6 years that we had in any business, because when you go back to 1997, M&S was the second or third largest publicly quoted retailer in the world. I think we were actually capitalized at that point with something like $28 million. Walmart was capitalized at that point at about $60 million. Walmart's capitalized now at over $250, $300 million, and M&S is capitalized at about 12 or 13. That's the price you pay for not actually staying on the ball and for having and losing the opportunity of driving your business forward. So, what did we try and do? Well, I did nothing really when I came back to the business. All I did was remind myself what had been kicked into me by David C's father and others, which was to understand what the business stood for. Those are the 5 words I've mentioned: quality, value, service, innovation, and trust. I reminded people that we had a good brand. I reminded people that our customers were well disposed to our business. I reminded people that if we had our confidence, the word I used earlier, that actually and showed our confidence, and not our arrogance, that our customers would come back to us. So how are we doing? Well, we're in pretty good shape, actually. If you believe the forecast for this year, the company will do pretty well this year. If you look at the other metrics we've got a strong balance sheet in our business. We've got very strong cash flow in our business. Profitability, as I say, will probably be the best we've had for nearly a decade. We've got very, very strong physical assets in our business. We're a company that owns nearly £6 billion of real estate. Now, interestingly enough, people talk about the share price now being below £4 again, and this is below the price that Philip might have offered. He never actually made an offer. Might have offered back in 2004. I think that's largely irrelevant, because back in 2004, first of all, our share price was depressed against other share prices which were not depressed. Today, all retailers are off by some 46 to 50% against the FTSE, and that is nobody wants to buy stock in a customer-facing business. But if you remember the words I've just said about the assets that we've got in our business, it is a bit nonsensical that you might be valued on the same multiple as a company that's got no assets, no cash flow, no profits, and no prospects. So I'll have to ask people to judge in time which ones they would rather invest in. One of the biggest assets we've got is not only the people that we've got in our business, but it's also the asset which we've got, which is our customers. We have 16 million customers who come into our stores every week. We are enjoying record market share, both in value and volume, for the last 6 years. We are market shareholders, leadership shareholders in ladies' wear, 12.5%. We're 3.5 to 4 times bigger than our next competitor. We've got 12% of menswear. We've got 27% of lingerie. We've got 5.5% of growing on kidswear. We've got 2.5% of a huge market in home and growing very strongly. And we've got 4.4% with a view to go to 5% on foods. And I think that's a sign of a business that's got a clear opportunity to really move forward. We've invested nearly £3 billion, not without some criticism in the last 3 years in our retail estate. I absolutely believe it's the right thing to do. I think we will come out of this difficult period and we will be better off for it, because if you don't invest in your real estate and in your brand, which is essentially what that means, actually you're only going to have to do it at a later stage. We have underinvested for the preceding 10 years. We've got a clear plan of what we want to do. So we will increase space in the UK where we still need it. We will open, for instance, a store in White City later this year. We will open a store down in College Wood in some